Hey there, this is Thomas. Welcome back to the channel. Today, I have another special video for you. This is actually a remake of one of my older videos that got very popular. We'll discuss the CPP, Canada Pension Plan, and more precisely, we'll talk about when is the best time to take out your CPP. Because while every Canadian who makes CPP contribution is entitled to get CPP, it can make a huge difference at which age you get yours. While the standard age for receiving the CPP benefits is at age 65, you can get it as early as age 60 or as late as age 70. And the age you decided to take it has a big influence on your overall finance. It is an important decision that you have to make for yourself. Don't make this decision based on what your coworkers or best friends did. What works for them may not work for your unique situation, unless they are in the exact same situation as you and live their life exactly the way that you do. But to give you an idea of what's possible, I'm going to share some approaches to the question if we should take out CPP early or we should wait for a couple years later. And I'm confident this will help you to make an informed decisions. So let's get started. First, let's get a little reminder on what CPP is exactly. CPP stands for Canada Pension Plan, which was created to provide Canadians with a steady income stream during retirement. You can only receive payments if you have worked and made contributions to the plan, and the amount you receive depends on how much and how long you contributed. Right now in 2021, the maximum CPP benefits is around $12,000 per month, but the average Canadian gets roughly around $690 per month. Now, the standard age to start taking out CPP is at age 65, but you have some flexibility. You can choose to withdraw your CPP as early as age 60 or as late as 70. If you take out your CPP at age 60, you will get 36% less compared to age 65. And you have to wait until the age of 70, you'll get 42% more guaranteed. And this has many Canadians wonder, should I take my CPP early at age 60 or should I wait until the standard age of 65 or even defer the benefits until the age of 70? Some things to consider are, will you still be working at the age of 60? Do you expect to live a long life? Also, do you have any other retirement saving vehicles like RSP or tax-free saving? So for the sake of this video, I will share some scenarios where it makes sense to take CPP early, as well as some where it's wise to wait. Please keep in mind that everything that I'm sharing is for informational purpose only, so make sure you talk to the right person before making a decision. The first thing to consider is, how urgently do you need your CPP benefits? Let's assume you're 60 years old, you have a mortgage, and some high credit card debts that you are paying off. In such a case, it might be an advantage to take your CPP early, because if you take it at age 60, that means you can get an extra income for 5 years earlier. You can pay off your debt faster, and by the time you're officially retired, you have most of your debt paid off and less to worry about. So even there's a reduction in the payout when you take your CPP early, the advantage is the 5 years of additional income. If we look at this chart, you can see that the break-even age of a CPP taken at age 60 is at age 74. That means if you start withdrawing at age 60, you're still ahead of the game before you reach age 74. And if you invest the money instead of spending it, and you can even delay the break-even age. The next thing to consider is your life expectancy. Statistics Canada shows that the average lifespan for male is at age 80 years old and for females is age 84 years old. Let's say if we do fit into the statistic, do you have a spending plan for your retirement? Please consider your overall cash flow during your retirement. Your CPP should be one source of income, but it shouldn't be the only source. What I always recommend to my client is a three-pillar system that makes sure you're stable during retirement, like a three-legged stool. Leg 1 is your workplace benefits, such as the work pension or the company matching RSP. Leg number 2 is the government benefits, such as the CPP, oas, and the gis. And lastly, leg number 3 is your personal savings such as the RSP, tax-free saving, or any other gains from your investment. Keep in mind that your 3 leggeds need proper planning because many of them are considered taxable income. So the last thing we want is to work hard for our entire life just to pay off our hefty taxes during retirement. Plus, your taxable income affects the government benefits such as the oas security. Just a reminder, oas security, it is an additional pension Canadians can receive as long as they live in Canada for a certain number of years, and you will receive the benefits. So if you want to know all the details about the oas security, please check my last video where I explain all the free of Canadians pension plans. And for this video, just keep in mind that when you decide to take CPP, it can affect your oas payouts. A good retirement strategy should make it possible for you to fund your lifestyle without giving too much money back to the government. In many cases, getting your CPP early can help you to avoid the oas clawback. And by the way, clients do ask me, "Hey Thomas, can I work and get CPP at the same time?" And the answer is yes, you can do both. And because you still contribute to your CPP, the following year will give you a bigger payout. And now you can put the CPP portion back to your RSP to offset the tax side. Also, did you know that you can stop CPP contribution after the age of 65 even if you're still working? That way, you don't get deducted from your paycheck and you can use it towards your own saving goals. Alright, the first thing to consider is what happens to your CPP if you pass away. And let me share two stories to illustrate this for you. Andrew is single. He worked hard for the past 40 years and recently retired. He has been collecting his CPP since he retired. Fast forward, 10 years later, he passed away. All his assets, including his work pension and RSP, will pay in full and go into his estate. His remaining portion of the CPP, however, will most likely be kept by the Canadian government. In return, the CRA will only issue a check of $2,500 to Andrew's estate. So yes, if you pass away and you're single, your CPP will go back to the Canadian government and your estates do not get it. Now, let's look at the other story. Henry and Mary are both retired and they both collect their CPP. One day, Henry passes away. In this case, Mary will get a portion of Henry's CPP as a so-called survivor benefits. And notice the word portion. It means that the survivor can only receive 60% of the deceased person's CPP's payout. Plus, it cannot be more than the CPP maximum payout. In other words, if Mary is collecting the maximum CPP payout already, she could not get any extra when Henry is gone. And by the time Mary passes away, the government will step in again and stops paying the CPP altogether and issues a $2,500 check to the family. So the issue is, if you wait until the age of 70 but you die shortly after, most of the money you pay into your CPP for years goes back to the government. So based on the three reasons that I just covered, many people do find it very compelling to withdraw CPP early at the age of 60. You get to spend on things that you like or save it for the future use, but at least you get to make your own decisions on how to spend the money. But remember, this is not a one-size-fits-all solution and everyone has their own definition of retirement. So I want to share some reasons that wait until 70 years old is a good idea. If you're healthy and expected to live into your 80s or 90s or even 100s, then you can get a bigger monthly payout if you start taking your CPP at age 70 guaranteed. And that even pushed the break-even age to age 81. Or today, you're in your 60s or 65 and you have a huge saving in your RSP. So you know that by the age of 71, you're forced to take out some of the monies from your RSP, and with the CPP combined, you might have to pay more tax and affect the oas payout. So instead, you can choose to delay your CPP and start withdrawing a portion of your RSP first. The goal is to find the sweet spot between receiving benefits and paying taxes, but be sure to talk to your accountant or a financial planner for that. As you can see, there's a lot to think about your retirement financially, and I always recommend to start looking into it 10 years prior. Anyway, if you want more videos like this, please give this video a thumbs up and share it to your friends who is thinking about CPP. And if you have questions about your situation, I have a link below where you can have a consultation with me. This is Thomas, and I will see you in my next video.